Hi everyone, Michael here. Now I've been getting a lot of requests from you guys to provide an update on the Australian housing market and the Australian economy. Now obviously there's been a lot going on in Australia. It's a really hard time for us all at the moment with all the lockdowns going on all across Australia, in New South Wales, Victoria, Queensland just recently got our lockdown, ACT in lockdown, Darwin going into lockdown. And so people are very uncertain with what's going to be happening to the future of the Australian economy and also to the future of the Australian housing market. So again, in this video, I'll give you guys an update. There's a lot to get into. I've got a lot of information for you on the Australian housing market, on the Australian economy and the markets overall. Okay, everyone, so let's not waste any time. Let's get straight into it. So as we can see here, it says that the growth cycle is tapering as housing becomes less affordable, which I'm sure you all know already. So how much exactly have house prices increased for the month of July? Well, it says here the Australian housing values have increased a further 1.6% in July, according to CoreLogic's National Home Value Index, and the latest rise takes housing values 14.1% over the first 7 months of the year and 16.1% higher over the past 12 months. So people, that is absolutely insane. Over the past 12 months, when we've been in a recession, even though we've got out of the recession technically, I think I'll get into later in the video how we'll be going into a double dip recession, but nobody was predicting this. None of the banks were predicting this. None of the economists at the RBA expected that house prices would explode so much during Australia's deepest recession in 30 years. But the rate of the growth is now starting to slow. So CoreLogic researcher director Tim Lawless described the market as strong, but it is losing steam. Mr. Lawless attributed the lower rate of growth in housing values to several factors, with dwelling values rising more in a month than incomes are increasing in a year. So that's right, this is absolutely crazy, everybody. House prices are increasing in a month more than our wages are going up in a year, and housing is moving out of reach for many members of the community. Along with declining home affordability, much of the earlier COVID-related fiscal support, particularly fiscal support related to the housing, has expired. So obviously last year we had a lot of stamp duty concessions, we had the home builder grant, we had a lot of grants, and also I think a big factor that really helped out first home buyers last year was couples were taking out $20,000 each of their superannuation. So then all of a sudden they had $40,000 for a deposit for a home. Now, some banks weren't really taking this, but what people would do is they'd leave it in their account for over 6 months, so then the bank wouldn't really ask any questions, but some banks would still lend to people anyways. And this is another big reason why prices have been going up, not just in Australia, but everywhere around the world. So on the flip side, demand is being stocked by record low mortgage rates and the prospect that interest rates will remain low for an extended period of time. Dwelling sales are tracking at approximately 40% above the 5-year average, while active listings remain about 26% below the 5-year average. The mismatch between demand and advertised supply remains a key factor, placing upward pressure on housing prices. So again, just simple economics 101, there's been a huge amount of demand for homes, there's been huge amounts of demand for cheap credit, but there's also been people not wanting to list their properties because of the situation that's going on right now. But okay, so let's break it down state by state to see what markets are the best performing markets and what are the worst performing markets. Okay, so first things first we'll have a look at is Brisbane. So in the month of July, Brisbane increased 2%. Annually, it's up 15.9%, and the median price in Brisbane is now $598,000. Sydney increased 2% for the month of July. It's up 18.2% over the past 12 months, and is now at a median price of $1,017,000. Canberra increased 2.6%, and it's up 20.5% year over year in Canberra, and the median price is now $793,000. Adelaide is up 1.7% for the month of July. It's up 15.7% year over year, and the median price is now $516,000. Melbourne, one of the lower performers for obvious reasons. There's been a lot of people leaving Melbourne to move to Brisbane and other parts of Australia. They just increased 1.3% over the month, and they're up 10.4% over the year, and their median price is now $762,000. So Hobart increased 1.7% over the month, 21.9% over the year, and Hobart now has a median house price of $688,000. $421,000. And Perth, they keep saying, Perth is going to come back, is going to have a big comeback, but Perth is still performing not too great. It just went up 0.3% over the month. It's up 10.8% over the year, and it has a median price of $532,000. Okay, now the best performer year over year, could have you guessed it, Darwin. Darwin went up 1.7% over the month, but it's up a huge 23.4% year over year, and it has a median price of $486,000. Now the combined capitals are up 1.6% month over month. Annually, they're up 15.1%, and the median is $740,000. But the regional markets have actually been outperforming the capitals, so I'm definitely glad that I moved regional last year. So monthly they're up 1.7%, yearly they're up 19.6%, and it has a median price of now $486,000. So it says here the pace of dwelling price appreciation has slowed across each of the capital cities, but Sydney has recorded the sharpest reduction, with monthly capital gain falling from 3.7% in March to 2% in July. According to Mr. Lawler, Sydney is the most expensive capital city by some margin, and it has also been the city where values have risen the most over the first 7 months of the year. So worsening affordability is likely a key contributor to the factor in the slowdown, along with the negative impact on consumer sentiment as the city moves through an extended period of lockdown. But okay, so what are some of the factors that has led to this crazy housing market, and what are going to be some things in the future, some headwinds that are going to come for the Australian property market and the economy? Well, first things first, what you have to know what's fueled this crazy housing market is record low interest rates. This is the RBA's cash rate, and as you can see here, it's fallen from around 6.5%, 7% around 2006, 2007, all the way down now to 0.1%. And look at this, everybody. This is another reason why house prices and stock prices, shares have been going nuts. This is the RBA's balance sheet. And as you can see here, in 2020, it went completely parabolic. Its balance sheet went from around 180 billion to 600 billion, increasing around 300% in a year. Also, the money supply, just like in the US, this is happening everywhere around the world. The governments and the central banks around the world are printing money like crazy. Look at the money supply in Australia. You can see in 2020, it was roughly around a bit over 100 billion. This is the MO or the M0 money supply, and it's gone to around 400 billion. So again, that's an increase of over 300% in a year. But with this crazy speculative bubble in the housing market and in the stock market, some risks are building up. So let's have a look, everyone. So look what's happening now, everyone. Investors flock back to the market with higher loan-to-value ratios. Now, I don't know if you remember, but remember that thing we had in 2018, the Banking Royal Commission, how we found out all the dodgy lending that the banks were doing and how they really need to tighten the screws? Well, that's just gone completely out the window. The banks are back to, giving easier loans. I'm speaking to some brokers now. They're saying it definitely is easy to get a loan now than compared in 2018. And that's why it goes to show really it's credit growth and low interest rates that fuel house prices, because in 2018 in Melbourne and Sydney, prices fell around 10 to 15% because banks didn't want to lend to anyone. So data from the banking regulator APRA shows the portion of new loans going to investors is once again rising. So what we had early in 2020 with all the government handouts and stimulus, a lot of first home buyers were able to get into the market when prices dropped a little bit in Melbourne and Sydney and some other areas. But now that affordability is becoming such a big issue, first home buyers or owner occupiers can't afford to pay these prices. And now that there's some big price increases, investors are taking out equity out of their other investment properties and they're using it to go out there and outbid first home buyers and owner occupiers again, just like they were doing in 2015 and 2016 and 2017. So listen to this, everyone. The portion of new mortgages lent on interest-only terms has gone up from pre-pandemic levels to 19.3% in the March quarter. So again, remember there was this big issue with banks giving out too much interest-only loans and it was fueling a crazy housing market bubble? Well, yep, forget that. They're back to doing that again as well. And listen to this, everyone. This is crazy. Those with a loan-to-value ratio of 80% or more has increased almost 42% across all borrowers, making it the highest on record. That's right, everybody. This is the highest on record, people taking out these low deposit risky loans. So again, we haven't learned our lessons of the past. It seems like this government and these banks, they really love fueling this crazy housing market bubble because it definitely benefits them with high stamp duty, higher council rates. So I've just got my new council rate for the financial year, and my council rates are up. So the local governments really do love that. And the state governments love that for the stamp duty revenue. And also the banks like it when people refinance and take on bigger mortgages because then that's more interest for them. So it said some of it can be explained of increase of first home buyers who typically have lower deposits than investors, but it says it can't explain all the increases in lending to people that have deposits of 20% or less, nor can it explain a significant increase from a lower base in the proportion of loans that are being made to people with deposits of 10% or less. And on top of that, in the most recent budget, we've had a government announcing a new or expanded scheme encouraging people with deposits as little as 2% to take out housing loans. Now that's absolutely crazy, encouraging single parents to take out 2% home loans. That's extremely risky, especially if you have a correction of just 5% in the housing market, which is very normal. Well, they're in negative equity already. So they say they think that carries some significant risk, which is obvious for those people, as well as adding at the margin to the risk to the financial system as a whole, which it definitely does. And this is something which is quite sad, everyone. The most recent census in Australia in 2016, and I bet it's even worse now, showed that the overall home ownership rate among Australians was the lowest it has been since the census began in 1954. So okay, now let's have a look at what the banks are doing, what the RBA is doing, and let's have a look at how the Australian economy is doing. So it says here, Australian lockdowns could lead to negative interest rates. Now, the RBA did say in its latest statement that negative interest rates were unlikely. Now, whether a central banker says unlikely, you can take that for they'll do it eventually. If they weren't going to do it, they'll say, no, we're not going to do negative interest rates. But their language changes very carefully because their words can actually affect the markets, the stock market, the housing market, just by words they say. So they have to be very careful. So if he's saying it's unlikely, well, I expect it will come when we do hit another recession. So according to analysis from the Commonwealth Bank CBA, the nation's economy is expected to contract by 2.7% into the September quarter. To put that into perspective, throughout the entirety of the 1990s recession, GDP fell by a total of 1.7%. And as you can see here on the chart, the 2020 COVID recession completely dwarfed the 1990s recession, the one we had to have. And who knows, this one could be even worse. But the banks already got their heads up on this. Listen to this, everyone. But even before it became clear that Sydney's lockdown would be measured in months and that it would drag significantly on the fortunes of households, banking regulator APRA has already been telling banks to prepare for a negative RBA cash rate. So people, I'm telling you, negative interest rates, it's only a matter of time before they come. While the effectiveness of negative interest rates on boosting economic growth is questionable and a source of significant controversy, it remains a likely next move for central banks when the next crisis does come. Well, I find this is very funny because we can see throughout the world, QE and low interest rates, they don't work. They give a short-term boost to the economy, but over the long term, it makes the economy less productive. But you can see all the central banks around the world, they're just doing the same thing again and again, print more money, drop interest rates lower, and I'm sure we're going to have more central banks around the world go into negative interest rates. Even though it hasn't worked in other countries, I'm sure they'll still do it anyways. But it's not only our economy that's struggling, China is now going back into another lockdown, and it's often said when China sneezes, Australia catches a cold, and China was really one of the main reasons why we avoided a recession during the global financial crisis from them going and buying up all our coal and all our resources. So for the Australian economy, a significant slowdown in China could scarcely come at a worse time. So according to CBA, up to 300,000 jobs could be lost due to Sydney's protracted lockdown, leaving Australia an increasingly economic divided nation where some states streak ahead while others fall behind. But since this article has came out, we've got Melbourne now in lockdown, we've got ACT in lockdown, we've got Darwin in lockdown, and if these lockdowns go into the end of the year, well, that's just going to have an even dire effect on the economy. So despite the forecast of a strong economic rebound, the V-shaped recovery, they all said, for the nation's economy in the December quarter, if lockdowns continue for a longer than anticipated or a global slowdown begins to impact our economy, a double dip recession is a very real possibility. And this statement here really sums it up for the housing market. If you had told someone 2 years ago that a global pandemic, forecasts of 300,000 lost jobs, and the possibility of a double dip Aussie recession would lead to skyrocketing house prices, you would be laughed out of the room. And that's completely right, everyone. I thought that we'd have a housing market correction in Australia in 2021, but the government came to the rescue, the central banks came to the rescue, they printed money like crazy, dropped interest rates to all-time lows, the banks loosened the requirements for lending, and house prices have gone the opposite way to where the economy's going. But you know how the government and the banks say we're all in this together. Well, I think the government and the banks have been doing really, really good. They haven't really been financially affected. And look at this, everybody. So Commonwealth Bank made nearly $9 billion in a pandemic year with the RBA's help. So what you have to know here is the RBA set up something called the Term Funding Facility, where they offered cheap credit to Australian banks. So Australian banks could borrow at 0.1%, and then they could go and lend that money at 2, 3, 4%, whatever they want, and they profit the difference. But do Australian banks still need the support of this facility, especially when Commonwealth Bank, it says here, reported a profit of $8.8 billion, up 19.7%. So as of June 30, the Commonwealth Bank has drawn on $51 billion worth over the same period. It drew on $50 billion in customer deposits. And it goes on later in the article that the ABC tried to contact CBA about this scheme and the RBA about it. They didn't really want to comment on it. But as we can see here, the banks have been profiting billions of dollars. Their revenues have been increasing a lot. Meanwhile, the average Australian has been suffering deeply over the past year. Now, also another big issue that's been happening over the year with the economy is inflation. So let's have a look at the latest inflation data for Australia. So Australia now has an inflation rate of 3.8%. So is it time to worry? Well, of course, the central banks are all of a sudden loving inflation. They're trying to pitch to us that inflation is good. But really what you have to know, inflation is eroding your money in your bank account, and it's really a tax, because when the prices of everything goes up, well, then that means the government's tax revenue goes up, and that also means the government's debt gets devalued. And high inflation is also another reason why house prices are going up, because look at this, everyone. Investors can get investor home loans for around 2% or 2.5%. So with inflation around 3.8%, they're pretty much getting free money. And not to mention the tax write-offs they get on top of that. Now we'll have a look at the unemployment rate. So Australia's unemployment rate has decreased to 4.9%, but I expect that is definitely going to rise with the prolonged lockdowns. Now again, the government and the RBA keep saying how our economy is rebounding and is so strong. Well, our economy is still actually less than was in 2013. Look at this, everyone. So as we can see here, Australia's GDP in 2013, it was 1.576 trillion, when now it is just 1.397 trillion. So even though right now we're not technically in a recession, for the real person, our standard of living over the past 10 years has been declining. Because we look here at wage growth, everybody. Wage growth down here is at an all-time low of 1.5%. Remember the good old days in the early 2000s when wage growth was over 4%. We can see here private debt to GDP in Australia is at an all-time high of 211%. Consumer credit just keeps on rising. People are piling on debt as they're losing income. They're getting in more and more of a hole, and Australians are piling on more and more debt, and it's just hit an all-time high of around $3 trillion. We can see household debt to GDP in Australia is also close to an all-time high of 123%. And retail sales month over month decreased 1.8%, and I expect this will continue to decline with the lockdowns. And we'll also have a look at the stock market. So the ASX is at an all-time high of 7,582. Now you may be wondering, why is this happening? Well, some of my thoughts why I think the Aussie market is now going on a rally is because of the PE ratio. The PE ratio, the price to earnings ratio, stocks are a lot more fairly valued in Australia compared to the US, with a PE ratio of 22.73 compared with the US markets, the S&P 500 of 34.8. And I think that's most likely because Australians, they like investing in property more than in the US. They prefer to invest in stocks. They do like real estate there in the US as well. but I don't think they're as crazy as real estate as much as we are in Australia, because in Australia we haven't had a huge real estate crash like they've had in the US. But also another shift I see coming in the economy is this remote working, or this working from home movement. Now, I do think it's really awesome, but unfortunately what it's going to lead to is a lot of these people that are working from home, well, if your job can be done remotely here, it can also be done remotely offshore. Look at this, everyone. So CBA is going to send 100 technology and compliance roles to India. Now, a lot of you saw this coming. I saw this coming, where a lot of people, they're moving to the regions, they're working remotely, they think it's great. And hey, if you can keep your job, it is great. But unfortunately, what I do see is a lot of these big, huge companies, a lot of the big banks and these big mega corporations, they'll be sending a lot of these jobs overseas. And that's just going to, be more bad news for the labor market here in Australia. So everyone, what does this mean for you and me? So what this means is, we've had a crazy housing market, crazy stock market. We've had huge amounts of stimulus. We've had this, crazy once in 100-year pandemic. And, a few months ago, it looked like we beat it. It looked like we'll be heading on this big V-shaped recovery. When now we're really back to square one. We've spent tens of billions, hundreds of $billions of stimulus. The Australian government has taken on heaps of debt. Consumers have taken on mountains of debt. But we're now facing another recession. So the Australian government and the RBA isn't going to have the same firepower to get us out of the next recession compared to the last recession. And there's just a lot of uncertainty. We don't know how long the lockdowns are going to go on. They keep moving the goalposts. We don't know what's going to happen. With all the uncertainty, it ruins confidence. And with the markets, a lot of it is due to confidence. So if we do enter into another recession, unemployment rate goes up, small businesses go bankrupt, and they don't provide enough fiscal support. If interest rates don't go negative, I think we will see a slight correction. I don't know how much in the housing market and in the stock market, but again, it's still very early to tell. If they do go highly negative interest rates, and if the government does all of a sudden take on mountains and mountains of debt, maybe it will be enough to get us out of this hole. But it's just so uncertain right now with everything that's going on. And really, it's up to the government, up to the central banks, what they're going to do. But what you have to know with bubbles and markets, they can be very irrational, and bubbles can go on for a long, long time. It's very hard to predict when it will pop, and we don't know what other black swan event could come up to trigger the crash. But what I do know is we're definitely not out of the woods yet, and all this data from this current lockdown is going to take us a few months to get that data, so we'll have a much clearer idea of what's going to happen with the economy and in the markets in 3 months' time. So everyone, that was an update on the Australian economy, on the Australian housing market with the data we've got at the moment. You let me know down below what you think is going to happen. Now, for all my loyal viewers and subscribers still watching, you're awesome. If you haven't already, please tap that like and subscribe button. I'll keep you updated with the latest happening in the stock market, housing market, and global finance news. And if you're bored, I'll put up some other videos here. I'll see you all there.